All right, so we will talk about disposing plant assets or fixed assets or equipment. Sometimes we call them long-term assets. Disposal means a couple of things in this chapter. Either to sell it or to just give it away or throw it if it doesn't have any value or if it's not useful anymore. So to dispose your asset, obviously we need to record journal entries for that, which might apply some calculations sometimes. And if you're selling it, you might end up with either gain or loss or no gain, no loss. To figure out if you have gain or loss is to compare the cash you're going to receive when you sell it with the book value up to date. That's how you figure out if you have gain or loss. So if the cash received from selling it was higher than the book value, not the original cost, the book value, the value today, not the value when we purchased it a few years back. So when the cash received was higher than the book value, that means we have gain. If it was vice versa, if the cash was less than the book value, then there's a loss. So gain or loss, we'll create an account for that and it will show up in our journal entry. And we're going to have an example for all those different scenarios. Okay, so regardless of the type of disposal, there are 4 steps. Bring the depreciation up to date. That's number 1. If I'm selling it in July, August, September, whatever, I have to record a journal entry to bring up the depreciation up to that date first, because that's how I will bring my the amount in my accumulated depreciation goes up to date, and that's how I figure out my book value up to date as well. So the other step is remove the old disposed of asset and associated accumulated depreciation from the books. If I'm selling it or throwing it away, there's no reason for me to keep the accumulated depreciation with balance existing there. I just have to get rid of it, and that equipment or whatever asset has to be reduced from our books as well. The next step, record the value of any cash received or paid. Determine the amount of any gain or loss. Okay. Let's have an example. Assume that on July 1st, PDX company discards equipment with a cost of $10,000 and accumulated depreciation of $10,000. Okay, first of all, the book value is 0 because the original value is 10,000 minus the total depreciation we did so far, which is the accumulated depreciation of 10,000. So 10,000 minus 10,000 equals 0. So there's no value anymore in this asset. And then we discard it, so it means we just given it away or we throwed it. So we did not get any cash back, in other words. So there's no gain, no loss, no cash received. So it's a very straightforward journal entry. It will have only 2 accounts, accumulated depreciation and equipment. The equipment account is an asset with a debit balance, so to decrease it, it has to go down to the credit side with the entire $10,000 because it's gone, and that was the original value. And then we had a balance of 10,000 in accumulated depreciation so far. That has to be debited so that we can eliminate that's how we can, so here's the 10,000. So to get that down to 0, we are going to debit $10,000. Okay, that's what we're doing here. All right, that was the first example. Again, there's no gain, no loss, no cash. The second example, suppose that instead on July 1st, PDX discarded the equipment, which has a cost of $10,000, but is not fully depreciated. Accumulated depreciation is $8,000 instead of the $10,000 we had previously. And annual depreciation is at $1,000. So remember, the first step is that we have to bring our depreciation up to date. In the previous example, we didn't have to bring it up to date because it was fully depreciated anyway. This time, because we do the depreciation at the end of every year, but when we discarded the equipment or the asset, it was July 1st. So there's 6 months of depreciation that hasn't been recorded yet. January 1st through June 30th of this year. So if my annual depreciation is $1,000, that means my 6 months depreciation is 1,000 multiplied by 6/12. That would give me the portion of depreciation associated with this year. So that gives me $500. Okay. If it was August 1st instead of July 1st, that means I have 7 months of depreciation. So I will be multiplying 1,000 by 7/12 instead of 6/12. Anyway, so $500 is my depreciation for this year. We will have to record this first as a first step. So here, depreciation expense $500 on July 1st, and then accumulated depreciation $500. So my book value is up to date now in my books, and depreciation has been recorded up to date. Okay, the next step is to record the disposal. Now, I'm not selling it. I'm not getting any cash. Let's make a T account for accumulated depreciation. So it used to be $8,000 credit balance, and we just recorded a depreciation expense of $500. So far, my total depreciation, accumulated depreciation so far up to the day we sold it or we discarded it, is $8,500. So if I'm throwing it away, I'm not selling it, I'm not getting any cash back, and the original cost is $10,000, that means in my books, I still have $1,500 value because I had $10,000 asset, or let's just call it equipment, and I had accumulated depreciation of $8,500. That's a negative. So I do have some value in my books for the equipment. It's $1,500. But because I'm throwing it away, I'm not getting any cash back, so I'm losing $1,500. So I have to think about the accounts that I need to use for the journal entry first, and then we put them together in a journal entry. So there's no cash. Definitely equipment, definitely accumulated depreciation. Equipment is $10,000. That's always going to be the original value. And accumulated depreciation is $8,500. And the difference between them is the $1,500. That will be my loss on disposal. So equipment, I'm decreasing that, so that will be a credit. Accumulated depreciation, I'm also decreasing it, so to decrease it, it will be a debit because originally it has a credit balance. And then loss, every time you think about the loss account, think that it's an expense. In your head, think it's an expense. So if I'm increasing the loss, that means I'm going to debit that. If it was gain, think about the gain as if it was a revenue. Okay, so loss is similar to expense. Gain is similar to revenue. Loss is debit. Gain is credit. Okay, so I have two debits, one credit. Let's see how that will look like. I'm putting them together in one journal entry. We'll always start with a debit first. So debit accumulated depreciation $8,500. Debit loss on disposal $15,000. And the equipment is $10,000. Total debits equals total credit. Okay, one more example. So this time we're selling it, we're gonna get cash now, okay? So there will be cash in our journal entry. We sold it for $1,500. Well, the book value was $1,500 and we sold it for $1,500. Do we have any gain or loss? There's no gain, no loss, because we got exactly the amount of money that equals the value up to date. which is the book value. So it's very similar to the previous journal entry, to that one, except that instead of having loss on disposal $1,500, I'm gonna have cash debit $1,500. Cash debit. I'm still gonna debit accumulated depreciation $8,500. I'm still gonna credit equipment for $10,000. Instead of loss, there's cash. Okay. All right. Let's have another example. Let's say that we sold it above the book value. Now, what is the book value? $1,500. 10,000 minus 8,500, $1,500. We were able to sell the equipment for $4,000. The company will record the gain on the sale of the equipment. What is the gain? How do we calculate the gain? The gain is always the selling or loss, okay? Or loss, the gain or loss. It's always the selling price. In other words, the cash that we will receive, okay? Minus the book value. Okay? If your selling price was higher than the book value, you will end up with a gain. If it was less than book value, then it will be a loss. So in our case, we sold it for $4,000 minus the book value of $1,500. So we have a gain of $2,500. Always remember, gain is a credit. If it was a loss, that would be a debit. So if we put all these pieces together in one journal entry, cash will be debit because that's cash in, so it's a debit, 4,000. Accumulated depreciation, I'm decreasing that, so it's a debit of 8,500. Remember, your up-to-date balance of accumulated depreciation in your balance sheet. That's what you should have in the journal entry. That's how you close it out. Equipment is a credit because I'm decreasing it by remember, it's always based on your original value, and then your gain, it's always a credit. That's your 2,500. If you add your debits, that will equal your credits. Okay. Another example, let's say we're gonna sell it below the book value. So let's say we sold it for $500. Remember, book value. Always think about the book value as a first step whenever it comes to selling above or below the book value. Always think about the book value first. What's my book value? $1,500. It's the 10,000 minus the 8,500. 1,500. Well, we sold it for 500. It's $1,000 lower than the book value. So how much are we losing? $1,000. Again, to calculate the loss, that's 500. That's the selling price. That's the cash I'm receiving minus the book value. There's a negative $1,000. Okay, so loss is always debit, just like expenses. So we have a loss, debit $1,000. I got the cash, $500, and then those two accounts, accumulated depreciation and the equipment, you're always gonna see them in the same situation, same place, same amounts. The equipment is credit 10,000 in the credit side, accumulated depreciation in the debit side 85. Okay, what will normally change is the cash, the loss. It might be gain, it might be loss. The amount will be different. Okay, there might be no gain, no loss if you sold it either exactly for the amount that equals exactly the book value, or maybe you just throw it away, but your accumulated depreciation was it was fully depreciated, so the book value was 0, and then you throw it away. So this way, there's also no gain or loss. Okay, those two. So what I'm going to show you now is just a recap on what we covered so far in this video. If it was fully depreciated, this will be the journal entry: debit to accumulated depreciation, credit to the plant asset. That's it. If it wasn't fully depreciated, but you're not selling it, you throw it, no cash, then you will have a loss in the debit. And if you're selling it above the book value, well, selling it at the book value, no gain, no loss, but this time you have cash instead of loss. This is also a quick recap. This time if you're selling it, so you have cash. If it was above the book value, there will be gain in the credit side. If it was below the book value, instead of gain, you will have a loss in the debit side. Okay, and then there will be cash, accumulated, plant asset. Those are going to be in the same spot. Okay, difference between above the book value and below the book value is, am I going to have gain or am I going to have loss? Gain is credit, loss is debit. Okay, that's it. It's this will be the last video for chapter 9, and I'll see you for the next chapter, the next video.